Hi guys, so I'm going to look at the question now. We need to solve this question just to check the steps that we discussed the last time on how to do consolidation. Remember, I gave you some steps, 7 steps on how to do consolidation. So I just want to test that understanding with you, those simple steps. So we're going to use the example on the right, this example, to check whether you really understand what we are talking about when I said the best way to simplify consolidation is to practice with those 7 steps and you build confidence in consolidation. So look at this simple question. We have Posta who acquired 60% on 1st of October 2024. On this date, retained earnings of the subsidiary was given, and likewise at 30th of September, which is after 1 year, the consolidated statement of financial position of Posta and Staple were as follows. So they've given us the Posta, which is the first one, the Staple, the second one, and some notes were also given. They said, as well as investment in Staple, Posta owed a small number of shares in various other companies. So there are other types of investment. These have a current amount of $61,000. And Staple has not issued any shares since acquisition. The Posta Group measures the NCI using the full Goodwill method. Anytime you hear full Goodwill method, please just know that what they are talking about is your fair valuation, right? And the Goodwill has not been impaired, they've also told us, and the market value of one Staple share on 30th of September 2024, 20x4, was $2.2. So that's an indication of the share price of fair value. Now the question is calculate the consolidated financial position as at 30th of September 2008, which is the standard question you will get, right? So this is a very simple question that is good to start with. Remember, and I told you, follow simple steps. Step 1 is the structure. Draw the structure. It builds your confidence. So you have a Posta here, and what did you do? He acquired Staple. And what percentage? He acquired just 60%. On what date? On 01 October 20x4. Simple. So you already know that Staple is the subsidiary, which is good. P is Posta, which is parent. Now the second step is to determine what consideration was when the acquisition took place. How much did they pay? Because they acquired 60%. So acquired 60% of the shares of Staple. And Staple had how many shares? This question said Staple has share capital, which is $1 ordinary shares. So which means one share has nominal value of $1. And if the share capital is 30,000 for Staple, it means that Staple number of shares will equals to share capital. Remember, you must have been taught this in your FA. Share capital divided by the price of one, let me call it nominal price, so that is clear, of one share. So this time around, the nominal price, which is something as par, some people call it par, right, or face value. The share capital is 30,000 and the share price is $1. That's the ordinary share price, which is your nominal price, and that means you have 30,000 shares. So this parent must have acquired 60%. So we need to know the number of shares they acquire. So they acquired 60% of 30,000, and that is how much? That is 6 times 3,000, and that's 18,000. So you acquire 18,000 shares. At what price? The fair value of one share of Staple, that note 5, they said is 2.2. So that's at $2.2 per share. So which means the price he paid will be equals to 2.2 multiplied by 18,000. And that will give us 39,600. So that was the consideration. So he paid 39,600 to acquire 60% of Staple. So step 2, we've done that. Now let's move to step 3, which is opening NCI. Very easy. Remember, I said NCI is the remainder portion anytime a parent does not acquire 100% of the subsidiary. So this time around, the parent only acquired 60%, so NCI will be 40%. So we know the number of shares is 30,000. So which means 40% of 30,000 shares multiplied by the value of the share. That's times 2.2, and that will give us NCI opening value of 26,400. And remember, we have used this fair value method because they have told us in the question that and the postal group measures the non-controlling interest using the full goodwill method. Anytime you hear full goodwill method, full goodwill means is using a fair value approach. Please take note. Because if it was not a full goodwill, if it was not a fair value approach, then the opening NCI would just be 40% of net asset of Staple at acquisition. So what we would have been doing is to get the net asset of Staple at acquisition, which would have been retained earnings of 34,000 and 30,000 share capital. That would have been the equity of Staple at acquisition. But this time around, the principle the parent has adopted is not a proportionate of net asset, but rather a full goodwill approach, which is a fair value approach. Now let's go to step 4. Step 4 is now to determine net asset at acquisition. I already gave you that inclination already. So net asset, they told us the retained earnings at acquisition was 34,000. That's the second statement on the acquisition date, right? Retained earnings 34,000. So retained earnings was 34,000. And share capital, since they have not issued additional shares, if you see it, they gave you that information in note 2. It says Staple has not issued any shares since acquisition, so which means that this 30,000 remains what he had at acquisition. So that is share capital of 30,000, and which means the net asset at acquisition must have been $64,000. So we have that. Then now we can go to step 5. And step 5 is about calculating the full goodwill. Remember, full goodwill means the combination of both NCI goodwill and parent goodwill. Yeah, so there are two ways you can do it. You can calculate it once and for all and just say the fair value, which is consideration of what parent paid, 39,600 plus opening of NCI minus total net asset. So you can say consideration, to write the formula again for you, plus NCI opening, which is on acquisition date, minus net asset of subsidiary. So that will be easily just equals to 39,600 plus, so I have 39,600 plus 26,400 minus net asset of 64,000, and that will give a goodwill of 2,000. Yeah, 2K, but let me just write it for you. So that's not 2. Yeah, $2,000. So that is goodwill. And if you want to even break it down further, you want to understand how we got it, you can break it down to parent goodwill and NCI goodwill. So parent goodwill would have been, you paid 39,600 minus net asset of 60% of 64,000. And NCI goodwill would have been fair value at acquisition 26,400 minus 40% of 64,000. If we put a calculator to that, let me do that quickly. You see, we're going to have the same thing. So for parent, we have 64,000 at 60%. That's 38,400 minus 39,600. Yeah, I'll take that from 39,600. So parent goodwill will be 1,200. And if I do NCI goodwill, that will be 40% multiplied by 64,000. I take that away from 26,400, and that gives me 800. And you see the total still gives us the 2,000 that we're talking about there. So that's about the goodwill. Remember, follow the steps. Everything becomes very easy. Then step 6 is to develop the template. So remember, step 6 is always about getting ready your template. And what your template is just the list of the items you have on the statement of financial position. The only thing you will add is your goodwill and NCI. So take for instance, we look at the statement of financial position we have here. We have non-current asset investment all the way down to equity and liability. So that's all we need to list down. So I'm going to start with non-current asset, the investment. Before I mention current asset, I'll put goodwill. Remember, we need to introduce that. Then I can go to current asset. And addition of all of that, we have total asset. So that is template for asset. Then I go to the capital and liability. The first one, the share capital. In exam, please write it in full. Don't put SC as share capital. Write it fully as share capital. Then you have the share premium. Then we have the group retained earnings. After that, we have the non-current liability, and we have the current liability. Then we can have NCI after. But before we introduce NCI, we can have equity and liability total. Then we can now introduce NCI, which will now have total equity, liability, and NCI. Yeah, which is what you expect to balance with the total asset here, right? So that is the template we're going to be using. Then we can go to step 7. And remember, step 7 is to consolidate. And when I say consolidate, I gave you 5 steps for that. So follow 5 steps to consolidate. The first step I gave you is number 1. Let me call it A so that I don't confuse that. Is to remove investment in subsidiary. And the share capital of subsidiary. So we're going to remove investment in subsidiary and remove share capital of that subsidiary. So investment in subsidiary is in the parent. So if you look at this, the entry I'm talking about here is like you are going to be debiting share capital of subsidiary, and you're going to be crediting investment in subsidiary. This one is in subsidiary's book. This one is in the parent's book. So in this question now, we've calculated investment in subsidiary, which is the cost of investment, that consideration we got here. We got 39,600. So that is 39,600 we're talking about. So we're saying take away 39,600, and likewise you need to take away 30,000. Yeah, because that is the share capital of the subsidiary. 30,000. I know you are wondering that something is still missing there. Yeah, that entry is not complete, and I'm going to post it complete for you so you understand how it works. Yeah. So, but that's the first step. So, which means the share capital, which is this one for the group, will just be 120,000. Sorry, 80,000 here, because that's all we got. 80,000. And the investment column here will now be 105k plus 10,000, 10k, then minus the investment in subsidiary. We need to remove that. This is 39,600. So minus 39,600. And adding all of that together will give you 75,400 for investment. That is the step 1, that adjustment that you have to do. Step 2 is to remove all intercompany transactions. Yeah, that is B. Yeah, remove eliminate all intercompany transactions. In these questions, we don't have that, so that is fine. We don't have to do that. Then step C is to combine all asset and liability. All assets and liability. So let's go and do that on our template. So for NCA, we need to combine 420, 520 plus 99330, and that will give us 519850. Goodwill, we've already calculated our goodwill. That is 2000. Let me write this properly so that it aligns with the other guys. 75,400. Yeah. So that's for current asset. Current asset is 78,900 plus 26,190, and that will give us a total current asset of 105,090. And adding all of that together, we have a total asset of 702,340. So we're done with the consolidation of the asset side. Now we need to add all the liabilities together. The share premium remains 120,000 as well for the parent. Then retained earnings. We need to calculate retained earnings. If you remember, retained earnings, we'll come back to that. I think that's my step 4, right? So we'll leave that. We're coming to that. Let's do the liability and asset as we have in our template. So non-current liabilities will be 100k plus 10k. And that gives us 110,000. Then current liability is 63,800 plus 23,080. And if we add that together, that will give us a total current liability of 86,880. So we are left with retained earnings now, which is our step D, the 4th step, which is about to calculate the group reserve. The only reserve we have here now is our retained earnings. And I've told you the way to calculate group reserve is, the formula is parent, any reserve account is about parent retained earnings or parent reserve, You don't need to make any adjustment to the parent. You just need to add percentage acquisition, right? Multiply by post acquisition retained earnings. So whether it's other reserves, valuation reserves, any reserve you have, this is the formula. So in this question, the parent reserve, which is parent retained earnings, was given to be 240,620. 240,620. So plus this guy acquired 60%. So 60%, and we got post acquisition retained earnings, which we calculated sometimes before. We said, okay, if we've not done it, we can quickly do it. What is our post acquisition? So retained earnings of the subsidiary is currently at 72,420. So, and before, on the date of acquisition, it was 34,000. So post acquisition retained earnings will be 72,440, which is what it is now, minus what it was on the date we did the acquisition. So that will give us a total retained earnings of the group to be 263,684. That is adding this plus this, right? So we'll move that. So that's let's move that to our financial statement. So we have 263,684. And let's call this working 1. So I can call this working 1. Group retained. So what is next in our steps? The last step is to calculate NCI. But before we go there, let's quickly add this together. 80, 120, that's 200. That's 463,683 plus 110,000 plus 86880. Everything gives us 660,564. Now the last step, which is step 5, is to calculate the closing NCI. Remember I told you closing NCI is opening NCI, just the same way you calculate any reserve, plus percentage NCI multiplied by post acquisition reserve. And in this question, the only reserve we have is retained earnings. So which means that's the only thing we'll be adding. We got our opening to be opening NCI. We calculated that earlier in the previous 7 steps. Yeah, that is 26,400. So that's 26,400. Then we need to do 40%, which is NCI, multiplied by post-acquisition retained earnings, which is similar to what we did here. 72,440 minus 34,000. And that will give us a closing NCI of 41,776. So we'll plug that in here, 41,776. By the time we add this to this, that will give us this line. And that becomes 702,340. So it's as simple as that. Following those steps, remember, always follows the steps. It makes life easy. Practice the steps. Naturally, you won't have to look at the steps again because it just becomes a routine for you, right? I want to show you how this usually balances out. It's very good to understand that because everything we are doing is just debit and credit. Look at the way we are adding all these assets together. Take, for instance, we are just saying debit and credit. That's all we're doing. Yeah. So take, for instance, if I want to consolidate NCA, I'm just saying debit poster. Sorry, because it's an asset. So I'm going to remove it from there. So I'm going to be crediting poster. That's the adjustment I'm posting. I just want to see you as it's good to understand consolidation from debit and credit perspective. So I'm saying credit poster account 420, 520. Credit staple account 99330. So I've removed it from the account. And where am I taking it to? I'm taking it to the group account. So I'm saying debit group account 519,850. That is what we are doing for every item, that we have consolidated easily. Now, for the date of acquisition, which is the adjustment we usually make in our step A, this step. I want to give you a full entry that happens on that day. I know a lot of you probably have never seen this before. And most lecturers don't also teach it like this because it can be confusing, but I'm going to break it down for you. This is what happened on date of acquisition. And I call it your date of acquisition adjustment because it's usually important to be able to understand this. If you understand this, consolidation is also simple for you. This is the adjustment that you are making. Remember, we said you must remove all the reserves in the subsidiaries account because it has been acquired. And equity is a credit balance. So to remove it, you must debit those equity balances. So you're going to debit the share capital. Take, for instance, this question that I'm looking at. So you're going to, on date of acquisition, what you are doing is you are debiting share capital 30,000, which is what I posted here, if you remember this entry. Let me use a different color. This entry, debit. So I'm debiting share capital, so I've removed it. Yeah, this one, share capital of subsidiary. Now the next thing, I'm going to credit investment in subsidiary, which is in the parent's book. So I'm going to credit investment in subsidiary. This is the parent's book. This is subsidiary's book. The cost of acquisition, which is 39,600, if I'm correct. Let me just check quickly. Yes, 39,600. 39,600. But it doesn't end there, it continues. There's other part of subsidiary account that is also equity that we need to take away, and that is retained earnings. So I'm going to remove that retained earnings as well, because the whole equity has been acquired. And the retained earnings on acquisition was 34,000 was given to us. So debit 34,000. So I've taken away all the equity item of that subsidiary. And I've also taken away the investment in subsidiary at cost by the parent. Now I need to recognize the NCI on the date of acquisition, because that is important. So credit opening NCI, because remember this is date of acquisition, so your NCI will be the opening figure, not the closing figure. So we have opening NCI, and we calculated our opening NCI to be, I think we got 20 something then. Let me just check. 20, I think we got 26,400 for opening NCI. Where's our closing NCI? Yeah, put it there again. Yes, 26,400. So credit opening NCI 26,400. This is the date of acquisition adjustment we are posting, right? And there's a goodwill on this transaction, so that would be a debit, because we paid more than the net asset is a positive goodwill, and we got that to be 2,000. If you look at all these entries, there are 4 of them, and they're usually 4. It's going to be always 4 like this. If there is another reserve account, there might be 5, but mostly these are the popular 4. Look at the total debit. This is a debit, this is a debit, and this is a debit. If you add all of this debit together, you have total debit of 66,000. Then if you add the credit together as well, you also have 66,000, and it's balanced. After this date of acquisition adjustment, everything is just debit and credit, easy. This is the complicated part of consolidation. Once you do this, take for instance the closing NCI. What you are doing to get closing NCI, you are saying what is the retained earnings from subsidiary after acquisition, share it into 2, 40% to NCI, 60% to parent. So you are saying for post-acquisition retained earnings, debit that retained earnings from the subsidiary, that extra, then take 60% to group account, which is what we did here when we calculated the group retained earnings. Yeah, that's what we did. We've credited as this is 60%. So you're saying credit 60% to group account and credit 40% to NCI. That's how you got your closing NCI here. Yeah. This is the remaining credit. So then adding asset and liability together is just like I exemplified for you here. It's just about credit and debit from subsidiary and parent and posting the opposite into the group account. And that one is super easy. This is the part that most students don't understand. If you can understand this date of acquisition adjustment, every other thing is super easy for you. I just thought to show you that, and I hope you understand it. If it's not clear, please let me know. I can even do another video on it, because this is extremely important. This is building a solid foundation for your consolidation. In the next video, I'll be looking at intra-group transactions. Stay tuned, and let's keep building this. Until then, bye for now.